So let me give you an idea of what the training class looked like. A typical prop shop, is outside of the financial system. So I worked at head office of my company, which was in this dull gray office building in Midtown Toronto, far away from Bay Street and all the financial centers. Basically, the building was filled mostly with call centers and other, miserable looking jobs. But when you got to the top floor, which was our office, this place was like a fucking clown college. Okay, I'll never forget stepping off the elevator. The walls were painted like bright red, bright yellow, bright blue, because the owner believed that these were the most stimulating colors. I was half expecting to turn around and see Ronald McDonald. And then you go past the elevator, there's a foosball table, there's like 500 TVs, all on the financial news channel. And then you've got like 50 rows of, or 50 or 60 trading desks. And I just couldn't believe it. And it was like, it was crazy to see such an insane looking place, in the middle of this office building, in the middle of this very boring part of Toronto. And compared to like the soul crushing misery of my clerk job at a mutual fund, I was in heaven from day one. And you sit down at training class and they tell you, our policy here is to throw shit at a wall and see what sticks, and you're the shit. They literally said that. They said that, like, we're going to hire a ton of you, most of you are going to fail, and the ones that stick around are going to make a lot of money. But first, you have to pass the training class, and then once you actually become a trainee, you have to make $2,000 in a calendar month. And they give you the basics of how to trade, but the three most important things you learn are theory means nothing, no one knows anything, and cut your losers quickly. Three pieces of advice that are still very useful in my day-to-day life. Then you learn the basics of trading, how to operate the level 2, which is the bid and offer system. You learn about ECNs, electronic communication networks that allow you to bypass the specialist and get your orders filled quicker and allow you to have these arbitrage opportunities. You can have a look at the article if you're not already reading the article to see how that looks. You're going to have to look at the pictures and the screen caps to see what the level 2 actually looks like. Then we learn about technical analysis, which is like chart reading, which doesn't work. And chart reading comes with all kinds of indicators like Bollinger Bands and stochastics and Fibonacci numbers and moving averages, all of which don't work, but they are, there is some use to them in terms of looking at the chart and seeing where the stock has been over the last week and seeing how it's moving. And then you're going to have to go on sort of gut instincts. But just going on technical chart reading absolutely does not work. We learn a little bit about fundamental analysis, which is analysis of the stock based on its numbers as a business. But I'll tell you something, guys. Traders do not ever look at a balance sheet. Okay, there is no business knowledge of the company going on. There was no one at my company who could read a fucking balance sheet. Okay, the only thing that you pay attention to on the fundamental side is product launches, earning reports, trial results, especially like pharma, like one of their drugs, their big heart drug. They release a big heart drug that works, or they fail at a stage 2 trial, and that means they've lost a lot of money. Mergers and acquisitions, product recalls, any like big news that's going to affect the bottom line. When that comes out, what that means is that stock's going to be in play. So it's going to be hot for the next 2 or 3 days, and everyone's going to be trading that, trying to get a piece of the volatile action. Next up, we learn what became my primary style and most of the guys' primary style there, which is high frequency momentum trading. You hear that term around a lot. There was a book called, I think, Flash Boys by this guy Michael Lewis, who wrote about it to some degree. Basically, it was momentum style trading, and at its simplest is just you just you just trade based on where you feel the stock is going to go. Okay, it's just trading on gut instinct from patterns that you've seen, thousands of times before. And the way we were taught was to scalp, make 1 to 3 cents a trade, and average 300 to 400 trades per day, and put all your buying power. Put $3 million into each trade, and try and make 1 to 3 cents on it. And you can make a ton of money that way. It is a stressful way to trade, but it was a very profitable niche for our company at that time. We also learned how stocks move. Every stock, the momentum of every stock is different, and it's almost like every stock has a personality. So the high volume, low price stocks like Ford aren't going to move much, whereas the mid-range, high volume stocks like Texas Instruments would have decent movement. I'm not sure how those stocks move now. This was back in the day. And then you've got the high-priced, high-volume stocks like Exxon, which had crazy movement. Exxon was very hot in 2006, but would rip your face off if you fucked up. So you had to be very careful with those volatile stocks. But if you could master them, that was where the best money was at. Then we learned about a couple other systems of trading. One was called rebate trading, which was basically you sit on the ECN, and the ECN offers you money for delivering liquidity. So you sit on the bid and the offer, you make even trades, and you just rack up the rebates. And I knew guys who were making 6 figures a year just sitting, making even trades, and making money on the rebates that they got from the exchanges. And finally, there was what was called dark pool trading, which has become much more prevalent today. Basically, dark pool is like an invisible market for institutional clients who want to unload, a large amount of shares without moving the market drastically. So if you're trying to unload $1 billion worth of stock, you're going to move the market very far against you. Okay, you could move the stock $3 or $4 by the time you get out of your position, and with each batch of shares that you sell, you are pushing the price of the stock further away from where you want it to be, and you're increasing the amount that you have to pay. So the dark pool was designed to for institutions or large companies to sell large blocks of shares to a buyer who is interested in buying a large block of shares outside of the actual market anonymously, and the value would be the buyer of shares would get them at a discount from the market rate, but the market wouldn't move $3 or $4 away from what the institution wanted to sell it at. So these would usually be priced 30 cents out. And we had a girl in Israel making $1 million off of basically just poking around the outskirts of a stock, bidding and offering 30, 40 cents out, finding one of these dark pools, and then arbitraging it between the market rate and the dark pool rate. And once you hit one of those dark pools, you knew that you were going to make like 3, 4, 5, 6,000 within a few minutes. When it was new, it was totally like unregulated, and it was crazy the amount of money that people were making on that.